Imagine you're just, sitting at your trading terminal watching the tape, and suddenly this massive alert flashes across your screen.
Oh, yeah, those alerts.
Right.
Yeah.
A whale has just slammed down a $25 million long position on Bitcoin.
That is a massive bag.
It's huge. And they've done it right as the price is colliding headfirst into this really heavy historic resistance zone.
Right at the ceiling.
Exactly. So your immediate thought might be, wow, they must know something I don't. I should probably buy too.
Which is what everyone thinks, yeah.
But what if that massive bet isn't a signal at all? What if it's actually like a beacon designed to lead retail traders straight into a beautifully engineered trap?
A trap that gets them completely wrecked.
Okay, let's unpack this. Welcome to Bitcoin Deep Dives by MyCryptoParadise. Today we are diving into an incredibly detailed research brief from Simon.
He's a lead analyst over at the Paradise team.
Yeah, and his notes dissect this exact $25 million setup.
Yeah.
The goal of this deep dive is to really pull back the curtain on the behavioral psychology of the market.
Because, we aren't just looking at red and green candles today. The charts are really just a visual representation of human emotion.
Definitely.
And Simon's analysis really forces us to confront this massive divide between the gambling mindset that plagues most retail traders and the disciplined mathematical ethos that our Paradise VIPs use to actually survive.
So let's start right at the scene of the crime, right? A $25 million long position placed right at a ceiling.
Yep.
To understand why this might be a catastrophic trap rather than, a stroke of insider genius, we really have to look at the emotional weather of the market.
We do.
What specific conditions make a trap like this viable in the first place?
Well, the primary condition is just a really high concentration of unchecked greed, like pure FOMO.
Right.
Simon's data points us toward the AI-driven fear and greed index, which, strips everything from volatility to market momentum to social media sentiment.
Just to give us a real quantifiable read on the psychology of the masses.
Exactly. And on the daily time frame, that index is currently sitting at 66.5, and it's accelerating right toward the 70s.
So the market is definitely warming up.
It is. But the critical alarm bell for a professional is when this index pushes into extreme greed, which is around that 80 mark. And that peak emotion perfectly aligns with a major price resistance zone.
Because that alignment creates a really dangerous divergence, right?
Oh, incredibly dangerous.
The price gets stuck at a ceiling, but the sentiment just keeps rising anyway.
Yeah, the retail guys see the price hovering there, and their confirmation bias just totally kicks in.
They think, oh, this is it. We are just gathering energy for a massive breakout to all-time highs.
Right, so they just keep hitting the buy button.
But what is mechanically happening on the other side of those trades, like underneath the hood?
What is actually happening is systematic distribution. In any market, every single buyer needs a seller. So when retail sentiment is at peak greed at a resistance level, they are happily providing the exact liquidity the smart money needs to offload their heavy positions.
Wow.
The price isn't pausing because it's gathering strength. It's pausing because every single time retail buys, massive players are quietly selling into them. They're just absorbing the momentum and capping the price.
Okay, wait. I have to challenge this premise for a second.
Sure, go ahead.
We have a whale throwing $25 million into a long position right at that resistance. If they have that kind of capital, why would we just assume they're the ones walking into a trap?
It's a fair question.
It feels kind of like assuming the guy buying up all the VIP tickets to a sinking ship must secretly know it's not going to sink.
Yeah, but see, it's a very common cognitive bias to equate large capital with smart capital.
Oh, interesting.
We naturally assume that wealth equals a flawless strategy, but the internal market data actually shows us that large positions often come from what we might call old money.
Like entities with really deep pockets, but no real strategy.
Exactly. A complete lack of precise risk management. Throwing $25 million at a major resistance zone isn't high probability strategy. It's just a brute force gamble.
Just rolling the dice.
Right. Professional new money traders, the ones who have grinded from zero, they operate like business owners.
They look for asymmetrical risk-to-reward ratios.
Exactly. And buying right at resistance offers terrible math.
Okay, that distinction changes everything. It's not about the size of the wallet. It's about the underlying process.
100%.
So if the real professionals, the actual smart money, are quietly offloading their bags at resistance while the amateurs are buying, how do they actually execute that?
It takes a lot of engineering.
Because if I have billions of dollars in Bitcoin, I can't just click market sell. It's like trying to drain an Olympic-sized swimming pool through a standard garden hose.
That is a great way to put it.
If you try to force it all at once, you're just going to flood the entire yard.
And flooding the yard in trading means experiencing massive slippage.
Right, slippage.
Slippage happens when your sell order is so large that it instantly eats through all the available buyers at the current price level.
So you just run out of people to sell to.
Exactly. And to fill the rest of your order, the exchange engine has to travel further and further down the order book.
Selling your coins at progressively worse and worse prices.
Yeah, and you end up creating this giant red candle on the chart, completely crashing the market and destroying your own profit margin.
So a massive player basically has two goals: avoid slippage entirely and stay invisible to professional tape readers who scan for those big market orders.
Right.
So how do they drain the pool without anyone noticing?
They utilize a really highly engineered execution tactic called iceberging.
Iceberging, okay.
Yeah, so instead of dropping one massive order on the books or, putting up fake sell walls to spoof the market, they use algorithmic software.
To do what exactly?
To create very small, seemingly harmless limit orders. But the mechanism is totally ruthless. The very millisecond that small order is filled by an eager retail buyer, the algorithm instantly refills it with another small order.
Oh, wow. So you literally only see the tiny tip of the iceberg above the surface.
Exactly. But there is a massive block of continuous sell pressure sitting right there below it, absorbing every single retail buy without ever pushing the price down.
What's fascinating here is the psychological manipulation required to make that iceberg strategy actually work.
Oh, it's brilliant and terrifying.
Because to absorb all that volume, these whales desperately need retail traders to stay euphoric.
They absolutely depend on it.
Simon's notes point out that large players will actually leverage media networks to push bullish narratives right as the price hits resistance.
They need you to feel that FOMO.
Yeah, that fear of missing out. So you just keep hitting the buy button. You are literally providing the exit liquidity they need to fill their iceberg orders.
They are essentially orchestrating the greed to facilitate their own exit. But, this phase doesn't last forever.
Right. The money runs out eventually.
Exactly. The buying momentum dries up, the retail powder is spent, and there is just no more buyers left to absorb the iceberg.
And when that happens, the smart money shifts gears.
Yeah. The distribution is complete, and the engineered push downward begins.
Which brings us to the charts themselves. Because when that floor falls out, the price doesn't just wander aimlessly, right?
No, it is very targeted.
It gets pulled towards specific structural targets. And Simon's analysis really highlights CME futures gaps as the primary magnets in this current market environment.
They are huge magnets.
But let's clarify the mechanics for a second. Why do these gaps actually exert a magnetic pull? I've always heard the phrase, the market hates a vacuum, but what is the actual mechanism driving the price back to those blank spaces?
Well, it really comes down to institutional algorithmic arbitrage. So CME stands for the Chicago Mercantile Exchange, right? Which is where massive traditional institutions trade Bitcoin futures.
And traditional markets close on Friday afternoon and reopen on Monday morning.
Exactly. But the spot crypto market trades 24/7.
Right. Crypto never sleeps.
Never. So if Bitcoin makes a massive move over the weekend, the CME chart opens on Monday with a literal gap. A blank space where absolutely no trading occurred on that exchange.
And the algorithms notice that?
Oh, yeah. Institutional trading algorithms are programmed to view those gaps as pockets of missing liquidity. They basically deploy capital to push the price back into that zone to arbitrage those untraded levels.
So it becomes a self-fulfilling structural magnet.
Exactly.
Well, here's where it gets really interesting. Looking at the current structure, we have a tiny gap sitting just above us.
Very small one, yeah.
It was created back in January with a high of $83,300, closing at $84,000. But once you look past that minor speed bump, there is absolutely nothing above us until the $126,000 mark.
Nothing but empty space above.
Right. So the true structural magnet, like the massive void waiting to be filled, is sitting ominously below us at $67,000.
And man, that $67,000 level isn't just a gap, it is a trap door.
A trap door.
Yeah, because if the market makers initiate a push down toward that magnet, it triggers a completely cascading liquidity event.
What kind of numbers are we talking about here?
We are looking at the potential liquidation of $16 billion to $17 billion worth of over-leveraged long positions.
Wait, 16 to 17 billion.
Billion with a B. When a long position gets liquidated, the exchange forces a market sell to cover the debt,
And that forced selling just pushes the price even lower.
which triggers the next set of liquidations, creating this incredibly violent domino effect.
16 to $17 billion of forced selling. I mean, that is an absolute avalanche.
It's market shattering.
And the internal data shows the fuel for this avalanche is actively being loaded right now, isn't it? We can see this clearly in the accumulated funding rates.
We can. Funding rates are basically the invisible current underlying the perpetual futures market.
Because perpetual contracts don't have an expiration date, right?
Right. Exchanges use a funding rate mechanism to keep the contract price tethered to the actual spot price of the asset. And right now, altcoin funding rates are turning negative, but Bitcoin's rates are shifting really heavily into positive territory.
Okay, let's break down what that actually means for a trader's wallet. If the funding rate is positive, it means the market is overwhelmingly skewed toward the long side.
Way too many people betting it'll go up.
Right. So the people betting the price will go up are literally having to pay a continuous fee to the people betting the price will go down just to keep their positions open.
Exactly. They are paying a literal premium to hold a bullish bet right at major resistance.
Which is just crazy.
It slowly bleeds their margin account dry.
Yeah.
And if the price stalls and consolidates, that slow bleed weakens their liquidation threshold.
Making that $16 billion cascade much, much easier to trigger.
Exactly. The trap is set.
And the technical indicators are flashing the exact same warning signs. Simon's brief highlights a severe MASD bearish divergence on the daily time frame.
A huge red flag.
For the listener looking at a chart right now, what does the internal mechanism of that divergence actually look like?
So MASD stands for Moving Average Convergence Divergence. It basically measures the relationship between two moving averages of a price to gauge momentum.
Okay.
On the chart, you might see the actual price of Bitcoin slowly grinding upward, making higher highs. But underneath that, the MASD histogram, which visually represents the momentum, is sloping downward.
Making lower highs.
Exactly.
It's kind of like throwing a heavy stone straight up into the air. It's still traveling upward, but you can literally see the velocity dying right before it hits its peak and falls back down.
The physics are very similar, yeah. The initial thrust was strong, but the lack of new organic spot buyers is taking over.
So the momentum fades even while the price climbs.
Right. When you see price rising while momentum falls, it tells you the upward movement is likely just a slow short squeeze, not a real fundamental rally.
And the historical precedent here is pretty brutal, isn't it?
It's terrifying. The last time we saw a daily close with a bearish engulfing candle alongside a MASD bearish cross, it served as the catalyst for a massive 33% market crash.
A 33% drop isn't just a minor correction. I mean, that is a structural reset.
It ruins people.
To visualize how a cycle like that plays out over time, Simon uses this really incredible analogy based on Elliott wave theory. He describes the market's 5-wave structural patterns, kind of like a breathing exercise.
It is a profound way to track market exhaustion.
Yeah.
Markets really do breathe in a very distinct sequence. Wave 1 is the initial inhale. Wave 2 is a sharp, short exhale.
Okay.
Wave 3 is the aggressive, massive, prolonged inhale. That's the strongest part of the macro trend where everyone gets totally euphoric.
Everyone thinks we're going to the moon.
Exactly. Then wave 4 is a shallow, sideways exhale. And wave 5 is the final, struggling inhale.
Like gasping for air.
Precisely. And based on the subwave structures tracking from the $75,000 level, we appear to be in that exhausted fifth wave right now.
Wow.
The market might have just enough breath left in its lungs to push up and close that tiny gap at $84,000, but it is running entirely on fumes.
And once that final inhale completes,
The broader macroeconomic exhale begins, and that $67,000 magnet takes over.
so if we step back and look at the board, we have massive iceberg distribution at resistance, a $67,000 magnetic trapdoor below, heavily positive funding rates bleeding long traders, and a MACD divergence screaming that momentum is dead.
It's a lot of red flags.
It really is.
Yeah.
So with all of these technical red flags flying, why do so many retail traders still hit the buy button? I mean, why do they willingly walk right into the trap?
If we connect this to the bigger picture, it fundamentally comes down to evolutionary behavioral biases.
Biology.
Yeah, human beings are biologically wired to make the worst possible decisions in financial markets.
That's reassuring.
Right. But we are herd animals. We find comfort in doing what everyone else is doing. When the crowd is euphoric, our brains literally release dopamine when we join them.
It feels good to follow the crowd.
It feels safe. And this is the core of the MyCryptoParadise methodology, really. recognizing that the amateur gambling mindset is driven by biology, while the professional mindset requires overriding those instincts with pure mathematics.
Amateurs enter the market totally obsessed with the outcome. They just want to hit the jackpot and get rich by next week.
Yep.
But professionals operate on a completely inverted paradigm. The focus is entirely on the process, on rigorous capital protection, and, quite frankly, on survival.
Because survival is the absolute prerequisite for profit. You can't win if you're dead in the water.
Right.
The harsh reality of trading is built on unforgiving probabilities. Let's say you develop an incredible, highly refined strategy with an 80% win probability.
Most people would think that's basically a license to print money.
They would. But mathematically, you are still absolutely guaranteed to lose 20% of the time.
That's unavoidable.
Totally unavoidable. Because each trade is an independent event, you could easily hit a streak of 5 completely unavoidable losses in a row, even while executing your brilliant strategy perfectly.
And that is the breaking point for most retail traders right there. An amateur hits 5 losses in a row, they panic, they assume the market is just rigged against them, and they abandon their strategy entirely.
Or worse, they revenge trade and completely blow up their account.
It reminds me of this behavioral science concept. If you drive through a red light at a busy intersection at 80 miles an hour and somehow you don't get hit by a car, you got a phenomenal outcome.
You're alive.
You're alive. But you used a terrible, highly dangerous process to achieve it.
And the psychological danger there is that your brain actually rewards you for surviving that red light.
You start to believe you were just immune to the traffic.
Exactly. In crypto, getting a lucky, massive win by abandoning your risk management, like, say, throwing a $25 million long at resistance,
Right.
it reinforces a toxic behavior that will eventually wreck your entire portfolio.
So how do the pros handle it?
True professionals manage the reality of those inevitable 5-loss streaks through strict risk-to-reward mechanics. They ensure their winning setups mathematically outpace their losing streaks.
They use stop losses.
Ruthlessly. And they size their capital so that a string of losses is just a minor operational expense, not an existential threat to their survival.
So what does this all mean? We've covered incredible ground dissecting Simon's analysis today.
We really have.
We started by examining how the illusion of extreme greed sets up a perfect environment for smart money to distribute their bags. We looked at the mechanics of iceberging, explaining how whales offload capital without causing any slippage.
Draining the pool with a garden hose.
Exactly. We broke down the gravitational pull of the $67,000 CME gap and how positive funding rates provide the exact fuel needed for a $16 billion liquidation cascade.
The avalanche.
And ultimately, we unpacked why relying on a disciplined mathematical process is the only way to override our biological urge to gamble.
To really anchor all of these concepts, I want to share the core affirmations used by the Paradise team.
Oh, please do.
These aren't just like motivational quotes, they're the psychological guardrails that separate the professionals from the liquidity providers.
Let's hear them.
I think in probabilities, not emotions. I remain calm and disciplined regardless of market volatility. I follow my system with precision, waiting only for high probability setups. I respect risk management and protect my capital above all else. Losses are simply data that sharpens my strategy, and wins are the natural result of disciplined execution, completely detached from the emotional outcome.
Wow. Those are really powerful guardrails.
They change everything.
Because if you can internalize that mindset, the charts stop looking like a casino and start looking like a data set. As we wrap up this deep dive, I want to leave you with a final thought to consider the next time you sit down at your terminal.
Good idea.
Take a moment to monitor your own physiology right after you execute a trade. Does your heart rate spike? Do your palms get sweaty? Are you holding your breath watching the 1-minute candles?
We've all been there.
If your body is reacting like you're strapped into a roller coaster, you aren't trading a mathematical system. You are just paying the market for an adrenaline rush. And the market is a brutally expensive amusement park.
It really is.
Think about what your biology is telling you about your risk tolerance. Keep your capital safe, trust your process, and we will see you on the next deep dive.